Hey guys, Stockaholics, thanks for being here today. The crude tanker market is heating up. Recently, I did a video reviewing some comments from these product tanker earnings calls. I wanted to do the same today with the crude tanker segment now that a couple of companies had started to report earnings. Recently, I listened to a conference call from TNK, Teekay Tankers, and Euronav. And I want to share some of the big ideas that these guys were talking about. Okay, first of all, the crude tanker segment is starting to catch up to the product tanker segment. And like any other cycle in the past, when one segment is starting to do very well, the other inevitably starts to catch up. That's what has been happening, okay? The reason that these guys say that this is happening is because there are new trade routes that are being established and they are less efficient ones. As mentioned in some of the previous videos I did, the reason they allude this happening is because of the Russian invasion of Ukraine and then the European response to it. Another interesting comment that I heard from these guys, they said that there hasn't really been a lot of evidence that the oil flows from these Russian pipelines has been dramatically lowered yet. So even though we're seeing a lot of that Russian crude come on to these new trade routes, there's still a lot of Russian crude going to Europe through the traditional routes on these land routes, right? And by the end of the year, the stricter oil sanctions are starting to kick in where they restrict all flows to Europe on these pipelines. But we'll see kind of what happens if they change their mind on that by the end of the year. But we'll see. If that continues, then expect much higher earnings for these tankers in the months ahead. Okay, one of the other points that they were making is that the earnings we have right now are counter-seasonal. On top of the comments I just made, the strongest period for earnings, the biggest demand for tankers is in the winter months, okay? And we are still not there yet. Summer is usually a period of low earnings. So could be some fireworks happening this winter, but again, we'll see about that. There was a question on the Euronav call from one of the analysts on this call. He was basically asking how sustainable is the market. He said, can we compare this outlook to historical episodes? Are we heading into a 2016 scenario or 2008? Basically, he's alluding to, is this the end of a strong period of earnings? Because in those 2 years, that was the end of those cycles. And Hugo de Stoop, he responds to that question. Well, we are seasoned enough not to make the mistake of predicting the market. But if you want my gut feeling kind of comments, I think that we are closer to a 2004 or 2003 for that matter than any other market that we've seen. That was the beginning of that last super cycle that we saw in tankers. And that is based on the order book and the price of new buildings. Order book very small and the price of new buildings is very high. And there is almost no capacity to build. There is no more room in the yard. So a little push from the demand side will give the market room to grow at certain levels, and then it should gradually improve because part of the fleet will be too old to be operated and there will be nothing to replace it. And that smells very much like 2003 ahead of a sort of 4 or 5 year cycle that they saw. That very much looks, at least from a fundamentals perspective, it looks like that. One of the other things that they were mentioning on these conference calls, I think this was Euronav, they mentioned this, that they are seeing that there are these arbitrage sort of things happening between these different vessel sizes. Normally, I guess, when you're in these strong markets, kind of most of the vessel classes kind of move in tandem, or maybe they're even driven by these larger vessels. That has not been the case over the last several months. The smaller ships have been earning more than the larger ones. VLCC earnings are starting to change, but that's because the ports in Russia, they're not designed for VLCCs, so they need these smaller vessels to go and pick up fuel from these Russian ports. And then what happens, they take that fuel on the oil on these smaller ships. They go to less scrupulous places like off the coast of Africa. A couple of these smaller vessels, they go and fill up these larger VLCCs. And then this is a very inefficient process, by the way, leading to more tightness in the market. And then that VLCC goes and takes it on some longer haul route, okay? That might start to change, which I'll get into a little bit later. As China opens up, a lot of these VLCCs, there's a potential for more demand because a lot of VLCCs go to these Chinese ports. And they've been doing all these weird things with their medical event responses. Okay, they have some comments about supply, which I wanted to talk about. Like they mentioned briefly from that comment from Hugo, both of these guys are mentioning very low orders. The guys on the T&K call, they were actually predicting that we are going to see negative fleet growth, something we have not seen in a long time in tankers, because there's very limited capacity to order and the fleet is getting very old. Okay. So this is what they were saying. Yes, sure. I think we're not seeing anything in terms. Oh, this is Christian Valdegrave of T&K, by the way. I think we're not seeing anything in terms of container ordering. Okay, what he's saying basically, there's low ordering. The container ships are ordering a ton of ships. So even though the tankers are in a strong market, there's not a lot of ordering taking place yet. Our yard spots opening up. So the yards are very full also. Certainly, if you look at a chart that he has, the shipyards are pretty full halfway through 2025, maybe even through to the end of 2025. Certainly, some shipyards are taking LNG orders through 2026. So there's not a lot of opportunity, at least for the next 2-3 years, to get in a order for a new ship. You may be able to find a few still late in 2025, but I don't think it's going to be massive amounts. So we're pretty confident still that the tanker delivery schedule in 2025 is going to be very low as it was in 2024. So we really don't see an opportunity to order tankers in scale until 2026. So that obviously gives a bit of a runway in terms of some confidence on the very low fleet growth expectations over the next 2 or 3 years. So really, even if you think about it from this perspective, even if the market and the situation in Russia was to suddenly change, it's from a supply side perspective, the market is still likely to look quite good for the next couple of years. They had some comments around scrapping. Last year we had reasonably high levels of scrapping. That's kind of come down this year. That's because we are in a stronger market. When you have good rates, you're less incentivized to go out and scrap your ship. But despite those higher earnings that we are starting to see, there is still a reasonable level of scrapping. So I guess that's probably why they expect those kind of rates to continue of those levels of scrapping, even going into the coming years. Okay. They also had some comments, I think this was from the Euronav call, on Korean shipyards. So just like we're seeing there's a lot of tightness in these shipyards themselves, there's also supply side issues in the yards themselves too. So there's difficulties in getting, your steel. And there's these inflationary problems, particularly in wages, where these Korean shipyard workers are beginning to strike, where they're demanding higher wages, just like a lot of other places in the world. So as tight and as restricted as the supply side is in terms of ships, in terms of building them, can also become very tight in the coming years as well. Okay. What else? Let's see. And they also had some comments about China. There are less vessels, VLCC or tankers being built in China compared to Korea, but there are similar issues happening in China as well. There are also some comments, like a lot of places out there, in terms of recessions. And I thought there were some interesting comments on that because, it seems very inevitable, at least in terms of Europe, for example, that they are going to go into a recession. I think about that differently in different places around the world. But if you think about why is Europe going into a recession, right? Is that going to lead to less demand from energy? Yeah, probably. But what's the real problem here? Why is there going to be less demand? It's because there's not enough supply, right? If you're cutting off all of these oil, or you're not getting enough natural gas, or you're not getting enough coal from your suppliers out there, inevitably that's going to cause problems in your economy. Inevitably that's going to lead into a recession. But the way you fix that recession isn't through less of these things, it's through more of them, right? So in terms of these tanker companies, to solve that problem, to solve that recessionary problem, you need to get more energy to these places, right? So they were basically flipping the script and saying, okay, that can actually be different than the way you're interpreting it, right? One of the things we're also seeing is that the Chinese economy is quite weak, but a lot of that also has to do with their response to the medical event, right? So if you see a change to their zero medical event policies, sorry, that's a weird way to say that, but if you see a change in that policy, that can also lead to more oil demand. And again, a lot of the vessels that go to China are these very large crude carriers. There's a lot of, in terms of overall ton mile demand for the entire oil tanker fleet, that is a significant amount, right? Something else I wanted to briefly mention on before I close this video. I was recently listening to a Macro Voices podcast. They had a guest on there, David Hay. And basically he was describing a little bit more what I was just talking about. When we're thinking about fuel switching, he's saying that there is a lot of evidence that is already starting to happen, where these electricity plants that might burn natural gas or they might burn coal are beginning to find ways to invest in some capex spending to change the way that they can generate some of that electricity. And the reason for that is because if you're paying tremendously high prices for natural gas to generate electricity and you're paying tremendously high prices for coal to generate that electricity, you can actually generate it a lot cheaper if you have the infrastructure to burn oil derivatives instead. So the price differential in terms of electricity generation for coal and natural gas compared to oil is huge. So it is incentivizing the Europeans to switch to oil. Okay, and again, when we might see that those electricity plants start to have some of that that fuel switching start to come online, and again towards the later part of this year, when you're in the seasonally strong period, when there's the high demand for tankers as well. So hopefully I'm not overly bullish on this video. Let me know what you guys think in the comments below. Have a great week.